Welcome to Stock Talk. Now, we're not just skimming the surface today. We're going deep, really deep, into a specific stack of source material you'll find fascinating. It details maybe the most dramatic regulatory filing we've seen this quarter.
Oh, yeah. Which one's that?
It's the Q3 2025 13F from Michael Burry's Scion Asset Management.
Ah, Burry. Okay. Always interesting.
Exactly. And this isn't just, checking quarterly performance. It feels more like a masterclass in high conviction, contrarian strategy, tailor-made for you, our listener, to really unpack.
Right. And let me tell you, having looked through this filing, it really does read like almost like a declaration of war on market euphoria.
A declaration of war, strong words.
Well, forget routine adjustments, minor portfolio tweaks. This is a complete strategic overhaul. The headline numbers alone are pretty astonishing.
Okay, lay them on us.
So the total portfolio value, it's absolutely rocketed up. We're talking $1.38 billion now.
Wow, $1.38 billion.
Yeah, and that's a staggering 138.8% increase just from Q2 2025.
Whoa, okay, that is a massive amount of dry powder being put to work very, very quickly.
Quickly.
And, when you look at how that capital is actually allocated, the immediate shocker is just, well, it's crystal clear, isn't it?
Oh, absolutely. Nearly 80%,
Oh.
79.5% to be exact, is dedicated to one single extremely bearish thesis.
The 79.5%.
Yep. That translates to $1.1 billion committed to PUT options against the companies right at the very epicenter of this whole AI boom.
$1.1 billion shorting AI through puts.
It's an unambiguous, highly leveraged statement. Burry clearly believes the AI sector is in a dangerous, unsustainable bubble, and he's positioned himself to capture what he thinks will be an immediate, maybe even painful, correction.
Okay, let's really unpack this core bet, because our sources, they're describing this as his, quote, most aggressive bearish stance on AI stocks in history.
Yeah.
Which, that really feels like the kind of conviction, the scale we last saw from him during the 2005 housing short, the big short stuff.
I think the concentration really validates that comparison. He didn't just, nibble around the edges here.
No kidding.
The absolute core of this short is focused on just two names. First, and this is the big one, $912.1 million in PUT options against Palantir, PLTR.
Okay, wait. $912 million shorting Palantir.
Yes, that single position, it accounts for a staggering 66.08% of his entire portfolio.
66%
No.
on one stock. People are calling that one of the most concentrated contrarian positions in modern history.
They absolutely are. It's extreme.
But hang on a sec, Palantir. Isn't there an argument that, as a key government contractor, it has a kind of fundamental floor, something that maybe de-risks it compared to, say, a purely speculative tech play? Are we maybe overstating the bubble comparison here?
That's a fair question, and that's where you have to dig a bit deeper into the analysis from the source material.
Okay.
So yes, Palantir is heavily tied to government contracts, that's true. But the argument against it, the reason for the short, seems to focus on the extreme valuation.
Extreme valuation.
Yeah, the current market price, as one source put it quite well, implies near-perfect execution for decades.
Near perfect execution for decades.
Right.
What does that actually, mean in practice for a company like Palantir?
Well, think about it. It means basically zero serious competitors managing to break into their very specialized government niche.
Right.
It means flawless margin expansion year after year after year. Consistent, massive government contracts rolling in for, say, the next 20 years straight without any major hiccups.
That sounds almost impossible.
It's a standard almost no company in history has ever met, especially one that has such heavy dependency on government spending, which, inherently creates concentration risk. Budgets change, priorities shift.
So Burry likely sees that huge gap between the sort of AI narrative driving the stock and the fundamental reality of execution risk.
Exactly. And he sees that gap as perhaps the largest and most vulnerable point in the entire AI sector right now. Palantir is the poster child for that vulnerability, in his view.
Okay, so if Palantir is target number one, taking up 2/3 of the portfolio, who else is in the crosshairs?
Well, naturally, you'd expect the flagship AI chip maker, NVIDIA.
NVIDIA. Makes sense.
Yep. He holds $186.6 million in PT options against NVIDIA. That accounts for another 13.52% of the portfolio.
Still a very big bet.
Still huge. And what's really fascinating here, if you remember, is that Burry actually held calls on NVIDIA earlier this year. He was briefly bullish, riding the momentum.
Right, I remember that.
So this move, this big short position now, indicates he believes that momentum has pushed the valuation way too far into, well, irrational territory, disconnected even from its admittedly stunning earnings growth.
Okay, so the targets are clear. Let's talk methodology. It just screams urgency, maximum impact. Our sources note that, what, over 90%?
90.1%, yeah.
Of this entire $1.38 billion portfolio is structured in options, puts, and calls. Why such an aggressive reliance on derivatives? What's the play there?
Leverage. Pure and simple. It's about leverage. And this is really crucial for you, the listener, to understand. Options provide what finance folks call asymmetric payoffs. Now, for listeners maybe less familiar, why use options instead of just, say, shorting the stock directly?
Good question.
Because if Burry is correct, and he's right about a sudden, maybe even violent AI bubble bursting,
Yeah?
the potential returns on those PUT options could be exponential, far, far greater profit than you'd get from simply shorting the common stock. The downside is capped at the premium paid, but the upside, if he's right, is massive.
So he's not just betting it goes down, he's betting it goes down hard and fast. He's swinging for the fences.
Exactly. He's looking for a maximum outcome. It strongly suggests he believes the correction isn't just inevitable, but possibly imminent. He's not positioning for some slow, grinding decline over years.
He thinks the market's at a breaking point.
Precisely. It suggests he sees the market right now at a critical inflection point, and that requires maximum leveraged exposure to capitalize. And, the speed of this shift is just as dramatic as the positions themselves.
You mean the transition from last quarter?
Yeah, the transition from Q2 to Q3, it involved a complete portfolio overhaul, a total reset.
Okay, tell us about that clear out. What did he actually get rid of to free up, over $1 billion to fund this massive AI short?
It looks like a very rapid, almost surgical reset. Virtually all his major Q2 positions are just gone.
And those Q2 positions, they were pretty bullish, weren't they? On growth, consumer stuff?
Very much so. That Q2 portfolio represented a significant bullish bet on growth and consumer resilience. We're talking major call positions on United Health Group, Regeneron, Meta Platforms, even Alibaba.
Big, established growth names.
Exactly. And clearing those out completely suggests a total rejection of that previous narrative. It's like he woke up and said, nope, wrong direction. He needed every single dollar available to establish this massive short position. It really indicates an urgent, singular focus on this AI bubble thesis.
Okay, so he builds this historic short position, nearly 80% of the portfolio. The next natural question, then, is where did Burry put the rest of the capital? The part he actually expects to earn a return on, the bullish side.
Right, because it's not just a short portfolio.
And that's where this bullish rotation thesis becomes really clear, right?
Absolutely. It's not just shorting AI. It looks like a calculated capital flight away from that speculative growth and back towards tangible value. Old economy stuff.
Makes sense.
That's really the whole narrative you see in the non-short portion of the portfolio. He's rotating into, old economy stalwarts, maybe some undervalued sectors. Look at his single largest bullish bet.
Okay, what is it?
Pfizer. $152.8 million in call options on PFE.
Pfizer. Interesting. How much of the portfolio is that?
That's 11.08% of the entire portfolio. Is his biggest long bet by far.
Okay, so why Pfizer? Is he just bargain hunting, looking for something that looks cheap after the post-COVID pharma slump?
That's likely a big part of it, yeah. He probably sees big pharma as deeply undervalued right now. Pfizer offers stability, generates real cash flow, has high barriers to entry.
Pretty much the exact opposite of a narrative-driven, high-flying AI stock.
Precisely. It signals a clear preference for that stability and, measurable value over the hyper-growth speculation he's shorting elsewhere.
Okay, Pfizer makes sense in that context. Then he's also dipping pretty heavily into the energy sector, right? With Halliburton.
Yeah, Halliburton Company, HAL. Call options making up 4.46% of the portfolio.
Halliburton. So, an oil services play.
Classic hard asset play. It definitely indicates bullish conviction on oil services, probably expecting sustained, maybe even higher, oil prices down the road.
And the thinking is, if capital flees high-tech speculation,
it often finds a home in tangible assets, things you can touch, and the infrastructure needed to produce energy, like oil services. It's a classic rotation move.
Okay, that fits. We also see, looking at the source material, a pretty nuanced shift in his healthcare exposure. He dropped those big commercial insurance bets like United Health.
Right, the UNH calls are gone.
And instead, he pivoted to Molina Healthcare, MOH. Common stock this time, not options.
Yeah, and this is subtle, but I think it's quite significant. Molina, MOH, focuses very heavily on government-backed healthcare programs, specifically Medicaid.
Okay.
So moving from those broad commercial insurance calls he held before, like UNH, to this very specific government-backed focus. Well, it suggests he might be anticipating demographic shifts or maybe policy changes that could stabilize and favor that particular sector of healthcare, almost regardless of broader market volatility. It's a defensive, maybe policy-driven bet within healthcare.
Interesting. And what about the smaller positions? Any value hunting he did in other sort of forgotten corners of the market?
Well, we do see a new position in SLM Corp. That's Sally Mae, the student loan servicer.
SLM.
So that suggests he's finding some value in consumer lending, specifically education financing. But here's maybe a moment for reflection. The only survivor, the lone holdover from his Q2 portfolio, is Lululemon.
Lululemon. LULU. The yoga wear stock. That seems out of place with Pfizer and Halliburton.
It does seem odd at first glance. It was the ultimate pandemic winner, right? And it's the only position he carried over. But, and this is key, it was drastically reduced in size.
Okay.
And maybe more importantly, it was converted from call options to just common stock.
Less leverage, less conviction.
Exactly. It went from being a huge, like 18% bet via calls in Q2 to barely a rounding error now, maybe 1%, just held as common stock. It almost feels like he looked at that stock and thought, okay, I need this capital for the big AI short, that's the war, but maybe I'll keep a tiny bit of common stock just in case consumer spending holds up better than I fear. It definitely signals sharply reduced conviction in consumer discretionary growth.
Got it. Okay, and finally, there's that one really fascinating small position in preferred stock. What's the strategic purpose of holding that Bruker Core preferred stock, the BRKRA?
Yeah, the Bruker Preferred is interesting. I think it's basically a smart financial hedge.
A hedge. How so?
Well, preferred stock, especially this one, it offers a fixed dividend. In this case, it's yielding 6.375%. So it provides steady, reliable income.
Cash flow.
Exactly. Amidst all the chaos and, frankly, the high risk of his very volatile options positions, which, remember, require constant funding, managing premiums, potential margin, calls this preferred stock, just sits there generating cash flow.
So that cash could potentially help fund the options premiums or just stabilize the portfolio a bit.
Precisely. It acts as a kind of defensive cushion underneath an extremely aggressive offensive play. It provides a little ballast against the binary win-or-lose nature of those massive put option bets.
Okay, so let's try and synthesize Burry's entire Q3 worldview for you, the listener, based on this filing. It seems to be. Capital will decisively rotate out of speculative AI plays like Palantir, which he clearly sees as narrative-driven, overvalued, and fragile, and into established businesses. Businesses with tangible assets, actual cash flows, reasonable valuations, like Pfizer and Halliburton.
I think that synthesis is pretty accurate, yeah.
Yeah.
But we absolutely have to underscore the extreme concentration risk here.
Right. Almost 80% betting on one primary outcome.
You're looking at nearly 80% of $1.38 billion riding on this AI downturn thesis playing out, and likely playing out relatively soon, given the use of options. This level of high conviction betting, it's going to lead to either spectacular success or potentially significant losses, and probably quickly.
Yeah, there's not much middle ground there. And this pattern we've seen, this rapid reversal, he was bearish tech in Q1, then aggressively bullish growth in consumer in Q2, and now this massive historic AI short in Q3.
What does that tell us about his pattern recognition, his trading style? I mean, most long-term investors hold positions for years, right? Burry seems to be turning over his entire portfolio almost quarterly.
It signals very active, macro-driven trading. He's clearly positioning around core global theses that he develops.
Not just buy and hold value investing. No, not at all. It means he likely believes the current market environment is incredibly volatile, presenting both opportunities for immediate rallies like he played in Q2 and potential for immediate sharp corrections like he's positioned for now in Q3. And he moves very swiftly, very decisively to capture those perceived shifts. You could argue this active trading is what enabled him to build up the massive capital base he needed to deploy for this huge Q3 AI short. He's actively reading the market tea leaves and placing big macro bets, not just sitting passively on value picks.
Which brings us, I think, to the most crucial question for you, our listener, as you process all this. It's about timing, isn't it?
Always is with these kinds of macro calls.
Bubbles, as we all know, they can persist far longer than anyone expects, longer than bears can remain solvent sometimes. And options, critically, have expiration dates.
Right. Strike prices matter. Timing matters.
So if he's early on this call, just like he was actually initially with the housing market back in the mid-2000s before the big payoff, he could face major mark-to-market losses on these puts. He could potentially even fail to realize the profits from the eventual correction if his timing is off by too much.
That's the inherent risk in using options for a directional macro bet like this. Being right eventually doesn't always mean making money if your instrument expires worthless first.
So the final takeaway here seems pretty stark. Michael Burry is definitively all in on his AI bubble thesis. It's one of the boldest contrarian bets we've seen in modern history.
Absolutely, and that extreme concentration in the Palantir puts, that 66% position, that's the clearest, loudest signal we have right now from any major contrarian investor about the perceived risks in AI valuations.
It really is a truly dramatic position he's taken. So as you digest this deep dive, here's a final thought for you to perhaps mull over.
Yeah, the critical question probably isn't just whether Burry is ultimately right about the AI valuations being stretched. History suggests valuations can stay stretched for a long time. The real question is whether he's right about the timing.
The timing.
Right. So, if history does truly repeat itself, if we think back to 2007 or 2008, what might be the leading market indicator this time around? What signal? Maybe something in the bond market, maybe a spike in the VIX, perhaps a sudden shift in government spending priorities, or something else entirely what would tell us that his massive short position is about to pay off. And, maybe more importantly, is that indicator even visible yet?
That is a fascinating question to leave things on. Food for thought indeed. Thank you for joining us on this deep dive into the source material. Until next time.